Hello and welcome to the Business Standard Morning Show. I'm Binu Sandhu. It's the 8th of December 2023 and here are the questions we will be answering today. Is India prepared for the next pandemic? What is holding back India's internet growth? What should you do with rate-sensitive stocks? And what is Jeff Bezos' 10,000-year clock? China is again grappling with a respiratory disease. Hospitals in several parts are operating at full strength for the last 2 months. Some are calling it walking pneumonia, which is mostly targeting children. Several European countries and the US have reported a sharp spike in child pneumonia cases, fanning concerns of another pandemic-like situation. While medical experts believe there's no need to hit the panic button yet, it is a good time to take stock of India's preparedness. Abhijit Kumar does that in our first report.
There is growing concern about a pneumonia outbreak in China that is affecting children, and it is spreading. The World Health Organization, however, clarified in a November statement that the spike in hospitalizations is due to common winter infections, not new pathogens. The WHO had requested information from China's health authorities, including laboratory results and recent trends in the spread of respiratory illnesses. The surge is being attributed to Mycoplasma pneumoniae, a bacterial infection that remained suppressed for 3 years due to long COVID-induced lockdowns. Epidemiologists believe that the long absence of Mycoplasma pneumoniae has made people vulnerable and incapable of fighting it. Although doctors believe that there is no immediate reason for concern, the spread of the diseases to the US and some European countries has made the world wary. Dr. Bishnu Panigrahi of Fortis Healthcare tells us how serious the influenza is.
It is a normal outbreak which happens during winter. And when this happened, a lot of the children were affected. Some of the reports came out as a Mycoplasma pneumoniae. Some were normal viral infections. So this is how it is. And even WHO has asked for some information, which so far has not been provided to WHO. So in other words, if I can answer, a lot of us are outside China are in the dark. So we don't know. But when you look at India as such, when we check with our hospitals across, I don't see a increase in incidence of children being affected. Normal viral that happens during this time in November, December, that's happening, that's all.
While the situation is being monitored, it prompts us to reflect on India's preparedness to deal with a health crisis like this. Dr. Panigrahi and virologist Shahid Jamil emphasize on intensifying vigilance and preparedness to deal with respiratory illnesses.
Number one, we have to be vigilant. See, there's no substitute to vigilance. The pneumonia patients, they do have the cultures taken. So far, there's no sort of a thing that which should scare us. We shouldn't be pressing the panic button.
The other is proper hospital care and making sure that healthcare systems are ready. Where we really took a very big hit during COVID is our hospitals were not prepared.
Medical practitioners believe India has made substantial progress in healthcare since the COVID-19 pandemic. The government has increased the healthcare budget, prioritizing the low socioeconomic segments. In September this year, Union Health Minister Mansukh Mandavia had said that by 2025, India aims to increase its healthcare expenditure to 2.5% of the GDP. However, state health spending declined relative to the GDP after the pandemic. Combined health spending by the centre and states fell from 1.23% in FY21 to 1.19% in FY23. It is projected to slip further to 1.17% in FY24, say reports. One of the reasons for this dip is the GDP's growth outpacing healthcare spending after adjusting for inflation and population growth. Analysts also point out that a part of the state health spending has stopped after the introduction of the centre's Ayushman Bharat insurance program. This could have serious implications during a healthcare emergency. Equitable access to healthcare services for all citizens, particularly for those at the lowest economic stratum, remains a chimera. Medical practitioners emphasize the importance of sustained efforts in surveillance, early detection, and a robust response mechanism to tackle outbreaks. A step in that direction could be public-private partnerships.
So building on public-private partnership more will be a good thing, because see, just expecting everything for the government to do is not the right thing.
Private hospital operators should really ask themselves, if they get land at subsidized rates to set up hospitals, are they admitting as many economically weaker section people as they promised they will do when they acquired the land?
The speed at which the COVID virus spread exposed the weaknesses in India's healthcare system. Though gaps still exist in healthcare delivery, genomic surveillance of new pathogens, medical research, better infrastructure, and strengthening the biopharma sector can go a long way in safeguarding public health.
The pandemic years took a heavy toll on humans and also on businesses. For businesses, things would have been much worse if it weren't for the internet. But India's internet growth rate has been slowing down for the last 2 years. It coincides with the fall in sales of entry and mid-level smartphones. So what is holding back India's internet growth? Ayush Mishra and Tariq Ahmed reach out to experts to find out.
India had about 881 million internet users at the end of March 2023. It is the second largest online market in the world after China. But there is a tangle of contradictions here. Despite having such a large user base, India's internet penetration is close to 50%. And after hitting the peak, the country's internet growth has been slowing down for a while. After registering a double-digit growth between 2016 to 2020, the internet growth slumped to about 4% in 2020 and 2022. And it grew only by 1.7% the first quarter 2023 against the same quarter last year. According to the Comscore data, the number of regular internet users in India has been stuck at 510 million since December last year. That is about 78% of the 650 million Indians who own smartphones. Even if it was about 100%, it would mean that half of the Indian population doesn't have internet connection. So clearly, a sizable population falls outside the realm of online education, online retail, and other services that the internet offers.
The smartphones have become progressively more expensive. And remember that not only are they becoming progressively expensive, but that they have become progressively expensive at a time when the people who now need to come on board are likely to be less wealthy, and they're probably with lower income, because one assumes that the slightly higher income people are a bit more resistant or a bit more able to absorb the price rise. So here we are talking about people who already were daunted by the price of internet access, the price of smartphones, who now are even more daunted because the prices are going up.
Smartphone prices at the entry level for 4G are still at a range where it is not easy for people to afford. Cost of these mobiles are slightly higher for the mass to buy. Majority of the Indians or the real Bharat lives in the villages, and the majority of the people are still living at a GDP where they will not be able to afford a high cost mobile. Even today, there are around 200 million people who still use feature phones. Okay, that feature phone is not using the internet.
According to the International Data Corporation or IDC, India's smartphone market has been declining and the sales are back to the 2019 levels. In the first half of 2023, 64 million smartphones were shipped, but it is 10% less compared to the sales in the same period last year. Leading smartphone manufacturers like Samsung, Realme, Xiaomi, and Oppo saw their year-on-year unit sales declining. But Apple, Vivo, and OnePlus saw their sales increasing in the first half of 2023. Experts have pointed out several reasons for the shrinking sales of smartphones in India. First of all, the low-end smartphone prices have increased after the pandemic due to the subsequent chip shortage. Smartphone manufacturers diverted most of the chip capacity to higher-end smartphones as they provide better margin. Also, the switch from the feature phone to smartphones has been very slow due to the widening price gap. Most feature phones cost 1200 rupees while the cheapest smartphone cost 5500 rupees. According to the global technology market research firm Counterpoint Research, 290 million people in India are still using the feature phones while 650 million have smartphones. Adding to that, India has been witnessing a robust growth of the second-hand smartphone market. Meanwhile, due to higher prices of devices and data, only 35 million Indians upgraded from feature to smartphones in 2022, compared to 60 million every year before COVID struck.
Even after 5G, we have seen there has been very little focus on sub 10, sub 12K segment as well. Okay. So gradually what we are seeing, the availability of handsets in the entry level or the base level is declining. Okay. And there are obviously business pressures on smartphone industry as well, because the market is not expanding. There is no expansion in terms of people buying new get new smartphones getting into the base, which means all smartphone vendors have to focus on the existing replacement and upgrade market.
So clearly, the rising cost of smartphones, a rising subscription cost, and rural slowdown are some of the reasons due to which internet growth has plateaued. Without addressing it, we cannot increase internet penetration.
Let us now turn our attention to financial markets. The Reserve Bank of India's policy outcome today could move rate-sensitive stocks across banks, financials, auto and real estate pockets, since most analysts expect the central bank to maintain a status quo on rates. The eventual rate cuts next year, they believe, could lead to positive moves for these pockets. So how should you position these stocks in your portfolio? Harshita Singh's report has the answer.
The Reserve Bank of India's monetary policy outcome today is likely to keep rate-sensitive stocks in focus. Shares of banks, NBFCs, real estate and auto firms could move higher post the policy, as the repo rate is widely anticipated to remain unchanged. However, rate cuts, analysts said, are expected to begin in the second half of 2024. This, they believe, will benefit these sectors due to lower borrowing costs. And investors should look to selectively buy to benefit from the policy easing next year.
Typically, sectors like bank, financials and auto are some of the sectors which are sensitive to the interest rates and tends to perform well when the rates are declining or remain stable for quite some time. We like banks because the sector is seeing good credit demand backed by the retail segment. In the financial space, we are selective on the companies which have high secured loans in their loan book and are lending to big ticket size items. In the auto space, we are bullish on the sector because the monthly sales numbers are encouraging and the proportion of premium vehicles is showing a growth, indicating that the margins and realization will be better. We recommend to remain selective and accumulate stocks from the sectors like banking, financials and auto to benefit from the rate cuts next year.
Analysts at ICICI Securities add that a strong capex cycle next year will likely trigger the corporate re-leveraging cycle. Thus, large banks may provide maximum alpha as re-leveraging is yet to revive and valuations remain reasonable due to the skepticism. At the bourses, Nifty Bank, Nifty Financial Services, and auto indices are up 9 to 41% this year, as against a 15% gain in the Nifty benchmark. The realty pocket, meanwhile, has surged 70%, becoming the top sectoral performer. Stocks like Prestige Estates, Brigade Enterprises, DLF, and Oberoi Realty have soared 68 to 131% till date in 2023. While rate cuts are expected to be positive for real estate by making home buying affordable, current levels leave minimal return potential for next year, analysts note.
Rate cut will be positive for the realty sector as it may become more affordable for borrowers to look at buying real estate. The real estate sector has performed quite well over the last year despite high rates. So in that sense, and a lot of these stocks could have become overbought and bit on the overvalued side. So investors, if they are looking at buying real estate stocks at these levels, they will have to be nimble-footed and be satisfied with small returns.
Analysts at Motilal Oswal expect real estate absorption to pick up once rate starts easing. Their top picks for the rate-sensitive pack includes Prestige Estate, Godrej Properties, and Sobha. Thus, while policy easing will bring positive sentiment for related stocks, analysts suggest investors to accumulate on a selective basis. Today, on 8th December, the market trajectory will be dictated by the RBI policy decision.
He's making plans for an early retirement. Business Standard.
Well, time will clear the air on RBI's next move and how markets will react to it. Moving on, Amazon founder and the world's third richest man, Jeff Bezos, is trying to turn back the hands of time. In this era of technology, he is building a giant clock in the hills of Texas, which will keep time for the next 10,000 years. Yes, you heard it right. Rimchim Singh has more on this ambitious project.
Deep inside the mountains in Texas, USA, the work on the 10,000-year clock, or Clock of the Long Now, has been going on slowly but steadily since 2018. Backed by Jeff Bezos, a man with really deep pockets, this clock will take over $42 million to build. Brainchild of Danny Hillis, who conceived it in 1986, this giant clock will tick once a year, its century hand will move once every 100 years, and a cuckoo will emerge once every millennium. It took over a year to drill 500 feet into solid limestone and quartz to create the space for the clock, and for another 2 years, a diamond cutting robot sliced stones to make stairs. The clock will be driven by giant gears within a shaft in the mountain and powered by thermal energy harvested from the changes in temperature associated with the day and night cycle on the mountain above. The clock can also be wound by people who make the difficult hike to the site for a visit. There is no word yet on the timeline of any kind. So what is the purpose of the 10,000-year clock? A note by Jeff Bezos on the 10,000-year clock website reads, "The father of the clock is Danny Hillis. He's been thinking about and working on the clock since 1989. He wanted to build a clock that ticks once a year, where the century hand advances once every 100 years, and the cuckoo comes out on the millennium. The vision was and still is to build a clock that will keep time for the next 10,000 years. The clock's website, meanwhile, says, if a clock can keep going for 10 millennia, shouldn't we make sure our civilization does as well? Indeed, the 10,000-year clock serves as a catalyst for introspection on the concept of time and our place within its vast expanse. The center of the clock will show a star field indicating both the sidereal day and the precession of the zodiac. Around this will be a display showing the positions of the sun and the moon in the sky, as well as the phase and angle of the moon. Outside this will be a double dial with digits, showing the year according to our current Gregorian calendar system. But when will this clock start ticking? Only time will tell.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
In a way, this clock will also remind us about the lasting impact of our actions on future generations. Well, that's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.